$7,500. That is the price tag for the dream vacation that you've been imagining. And I'm not just talking about the flights and the hotels. I'm talking about the excursions, the fancy dinners, and maybe that once in a lifetime activity you've always wanted to do. Now that is a trip that creates lifelong memories.
You and I both know it's more than just a vacation. It's a chance to truly recharge and step away from that daily grind. But here's the million-dollar question. Can you take that fantastic trip and still keep your money growing the entire time?
Even better, Shawn, can you do it without draining your savings, without falling behind on your other goals, and without that terrible post-vacation financial hangover?
Stick with us, because we're about to show you exactly how to make that happen. We'll use a powerful strategy that we call the save and spend system, often referred to as infinite banking. We'll be sure to break it down piece by piece so you can see exactly how this works out in the real world. And don't worry, I've utilized this exact process countless times to take my family all over the world, so I know it works. I mean, come on, look at my tropical shirt. I travel.
Let's set the stage. You want to take a $7,500 trip. Now, most people see two main options. You either, one, put it on a credit card and you just pay it off later, or you save up cash and you just pay for it in full.
Let's talk about the credit card first, Jonah. If you can't pay it off immediately, you're looking at some devastating interest rates. I'm talking between 20 and 30%. Let's be generous and say that you have a card that's only 20%. If you spread that $7,500 over just 2 years, you'll pay more than $1,600 in interest alone. Yikes.
And that's money you'll never see again. Plus, it's kind of a one-way ticket straight into the bank's pocket. The bank's in control. If you miss a payment, your interest rate might spike or your credit score might take a hit, and then you're just stuck in this cycle of debt. You're entirely at their mercy.
Now let's look at the cash option. Extremely popular. You save up, then you write a check out for $7,500. You tell yourself this was the best possible option because now I'm not taking on any additional debt. But here's the issue that nobody talks about. That $7,500 that you just spent will literally never make you another penny again. We call that opportunity cost.
You should think of it this way. If you had left that $7,500 in an account and maybe it was earning like modestly 4% a year, over 2 years, it could have grown to $8,100. That's a difference of $600 in lost growth if you spend the cash. Now, you still got your trip, but the moment you spent the money, it completely stopped multiplying.
And here's the third option. And this is where things get really interesting. You've been diligently funding your save and spend system, and you've got at least $7,500 in available cash value. Instead of draining that account or swiping that credit card, you decide to take a policy loan.
So here's the key. This is not a bank loan. There's no application, there's no credit check, there's no approval process. You simply just call the insurance company. You request your loan, and then a few days later, boom, your funds are in your account. That's it. You're kind of like the CEO of your own bank.
The crucial part is this. You're borrowing against your cash value, not from your cash value. That means your original $7,500 never actually leaves the policy. It stays in there, earning guaranteed growth and dividends the entire time.
For our example, let's just use like a 5% simple interest rate on the loan, and we'll mirror a typical repayment plan. So maybe $329 a month over 24 months. Over that time, you'll pay around $395 in loan interest.
But here's the magic, Jonah. Meanwhile, while your original $7,500 is still compounding in your policy at roughly 4% a year, over those same 2 years, that's about $612 in growth. The net result, you're actually ahead by $217 even after paying that loan interest. That means you took the trip and ended up with more money than you started with. Not too bad.
And this is why it's such a game changer. You didn't interrupt the compounding process. In traditional savings, when you pull money out, the money stops earning, and that's just a bunch of lost momentum.
You see, in the save and spend system, your dollars keep working relentlessly in the background. You get to enjoy your trip now without derailing your long-term plans for the future. The trick is, you're using the insurance company's money for the trip instead of depleting your own.
Yeah, that's the real secret. Uninterrupted compounding. Even while your money is backing a loan, it's still earning. You're putting your money to work for you twice. It's once as collateral and once as a growing asset.
Another huge win, You're in complete control of that repayment schedule. Want to pay off the loan early? Great. Need to pause for a couple months because life happens? No problem. The loan interest amount is preset for the year, so you already know exactly how much you will accumulate. You'll have peace of mind knowing any loan that you have out will always be secured by your own cash value, and you can start repaying whenever you're ready.
Now, you've just got to compare that to like a credit card company. They don't care if you've had a bad month or you've got an unexpected bill. If you miss a payment, you are penalized immediately. However, with the save and spend system, you actually set the rules.
Plus, every payment that you make on that loan is just putting money back into your system. Instead of sending your money out to the bank and never being able to use it again, you're recycling those dollars for the next opportunity or that next family trip.
It's not about whether something costs zero interest. It's about whether your money is still working for you.
And get this system keeps your money working even while you're out living your best life.
Now, you might be thinking, it's only a couple $100 difference. Is it really worth it? And I've been there before. But the answer is a resounding yes, because this is about actually building a better financial mentality and financial habits. You take one trip this way, and then of course you might need to fund a home reservation this way, fund your new car this way, even your business startup the same way. Over the years, those small gains turn into massive numbers.
And because you're in control of your capital, you avoid the financial roller coaster of having to qualify for loans, paying fluctuating rates, or draining your hard-earned savings every time you want to do something big.
This is the same principle that banks use to get rich. Keep money in motion, earn, recycle it through the same system over and over. Now you just do it for yourself.
If you've got a dream trip, a major expense, or simply you just want to build a system where your money never stops working for you, this is the way to do it.
So click the link in the description and book a free strategy call with us. We'll show you how to set up your own save and spend system so you can fund your lifestyle without losing your financial momentum.
Enjoy your life now and keep growing your money forever. That's what the save and spend system is all about.